But we should not forget that emerging market has been the bad child of the whole story for a long time.
So, good morning, Bruno. Last time you came in a month ago, we discussed a rare pattern on the US interest rates. Can you tell us how it's all worked out, please?
Good morning, Jessica. Yes, indeed. As we see, we had this island reversal at the bottom of the charts in February, and that was calling for a rebound of interest rates. That's exactly what happened. In fact, it broke through the descending trend line and rose now all the way to 180, which is the top Bollinger Bands as well. So here it should probably pause for a little while.
And has the same pattern played out for the financial sectors?
That's right. You recall that we had also an island reversal on the financial sectors, and with interest rates on the long end rising, that also produced a rebound which developed quite nicely and now is reaching almost to the 62% Fibonacci retracement. And also on the top part of the panel, we noticed that here we have also the rising relative strength of the financial versus the S&P.
And has the same played out for the oil sector?
Yes, as we could expect, there was a rebound also on the oil sector, which was not only on oil here, as we can see, but also on copper. We noticed that it's almost make a kind of a double bottom, so it's kind of securing the fact that oil should not decline too much from the current level of around 39, where there are some resistance and it could pause.
And I imagine the impact on the US energy sector was positive following this.
Exactly. The same correlation is still working out. We don't know if it will continue to work out in the future, but definitively there was a rebound from mid-February till now March. And also it took time for the dotted line here, which represents the relative strength of the energy sector versus the S&P, to start to rebound, so to start to do a bit better than other sectors.
And all in all, for the S&P 500, is this the start of a bull market?
So now we had the months of a rise. Where do we stand? We see that from 1810 we rose all the way to around 2000, and we have something popping up below this big red arrow. This is the long-term 200-day moving average, which is since December descending. And this is an important feature because a descending moving average 200 days is very often able to act as resistance and cap further rise on the market, despite the fact that the momentum has been up. So we should have a quick look at what happened on the daily charts. On the daily charts, it was overbought, and as we expected over the weekend, because we had the chart of March 4th on the weekly, we see that just yesterday, finally the market realized that it was overbought and started to move down. And this is probably only the beginning of a down move, which could last for a few weeks and reach at minimum the cloud around 1950, 1940.
But emerging markets were rising last week, so can you tell us a bit about that?
That's a good example of it is Brazil. As we see, we had almost a parabolic rise and a very strong rise in the relative strength. But we should not forget that emerging market has been the bad child of the whole story for a long time. They have been underperforming, as we see here with the orange dotted line coming down all the way versus the S&P 500. So when there is a rebound, usually at the end of the rebound, the global rebound, the last most oversold markets tends to react quite fast. And that's exactly what happened. And probably it is just a short-term fire.
And where do you see the rebound for Japan?
Well, here there are some rebound. In fact, we have to notice that we broke a downtrend line around 16,300. And we're reaching toward the cloud towards 17,400. But we have a little problem up here on the upper panel. The relative strength of the Nikkei versus the S&P has been flat and just rebounding last week. And also the yen is still rising. So that should hinder a little bit the further rebound of the Nikkei.
And finally, Bruno, looking at Europe, are you still cautious?
Here to the Euro stocks, And what we see is two things. Number one, we had a rebound, like all of the other markets. We broke also a down trend line, but we remained below the key resistances, which is in January 30.55. And we see that here we are also capped by the clouds, and overbought indicators here on the stochastic is relatively at the top pace. So we should, in fact, expect a normal pullback towards the former broken trend line here in the vicinity of 29.30. So what we need to control for this week is if yesterday's first down days is going to be followed by further down days, and then confirming our theory that maybe we have seen the top and we are going to correct for a few weeks.
Great. Well, Bruno, thank you for telling us what to look out for.
You're welcome.
That's all from myself and Bruno, but for all the latest Dukascopy market moves, do keep clicking back. Goodbye for now.